Some new reports out this week show some mixed visions about where mortgage rates and the housing market is headed. So what are the experts saying and what do you need to know?
That is our big story today. New numbers out this week show U.S. home prices ticked up slightly in February. That ends a 7-month streak of declines. The National Home Price Index shows a 0.2% increase between January and February. Prices were down almost 5% from their peak in June of last year. However, the broader long-term trend going back to 2019 is showing a steady increase in home values.
Well, that news comes alongside reports by the National Association of Realtors that its pending home index sales fell over 5% last month. And that's according to Reuters. The pending home sales index is based on signed contracts to buy previously owned homes. It's now the lowest it's been since December, and it's a much lower number than some of the economists out there predicted. Some of that due to the lack of housing inventory on the market.
Mortgage rates rose a small amount this week. That is according to Freddie Mac. The 30-year fixed rate averaged 6.43. It's up slightly from last week's 6.39. This time last year, the number was 5.10. However, Freddie Mac's chief economist says this could mean lower mortgage rates for the rest of the year. That could provide some relief for borrowers trying to buy a home.
We know interest rates are high and inventory still low. So what can you expect if you're starting your home search? We have Nick Bailey with us, the president and CEO of RE/MAX. So let's start with the first-time home buyer out there. What should they expect this spring and summer?
Well, hi, Christina. Thanks for having me. You know, the spring market's here, and there are certainly some bright spots. On average, home sales from February to March are up 30%. But there are a few more things going on that buyers should be aware of. You're right. Inventory remains fairly low. Days on market, especially in the Toledo area, have remained unchanged. It's just around 2 months that a home sits on the market. But there's something else that's happening. The demand continues to be fairly high. And that's why the median sales price is up just over 6% in your market compared to a year ago. And so prices are continuing to go up, but not at the double-digit rates that we saw a year or two ago. However, there's something more important for buyers that's giving them a chance. Homes are selling for only about 1% less than ask price, but a year ago, they were selling well above asking price because so many buyers were competing with each other. That has cooled a bit, which is welcome good news for buyers.
Okay, so let's talk about things like the interest rates out there. Of course, that has changed the game for some people. Are the higher mortgage rates changing things, or, as you mentioned, are people still buying?
The quick answer is yes, they are still buying, because for the vast majority of people, the timing of the market is really about what's happening in their life. Getting married, getting divorced, moving for a job or loved ones. And it really comes down to more about, do I have the down payment and can I afford the home and does it fit my needs? And that's what most people focus on versus, did I time the market because of interest rates or inflation or the economy? It's really about personal timing for lifestyle. But here's the thing to know about rates. They've certainly had an impact and been at the center of the conversation. But buyers right now are not just looking at the 30-year fixed. There are lower interest rate opportunities out there with things like adjustable rate mortgages, interest buy down opportunities, first-time homebuyer programs that have lower rates. And so for buyers, don't just focus on the 30-year fixed. Shop your rate, have a great lender, and look at the other products out there, because that may make the difference on whether you can get into the home that you want.
Well, let's talk about sellers here. In our area, in a lot of cases, homes are still receiving multiple offers. So are there certain things that you should be doing to make more money or get that faster sale?
Number one thing that sellers can do right now is price the home correctly. And that can be done with the help of a great agent. Having that trusted advisor that knows the market can help you navigate pricing. Because the biggest mistake that home sellers make is saying, well, let's price it high, we can always come down. And it's a mistake because on average, when people do that, they can end up selling anywhere from 5 to 8% on average under market value. So price the home right. Second thing I would say is homes are starting to compete against each other a little bit more than they were a year ago. And so you may have to do some slight home improvements, stage the house. When you've got a house price right and the house looks right, that's the best formula for you to get the most money in the least amount of time.
All right, and finally here, do you think that we will see the housing market go back to the pre-pandemic or the surge during the pandemic? Or is this where we're at right now, higher interest rates and all, the new normal, if you will?
Well, what's interesting is this market looks a lot like pre-pandemic. There are a lot of similarities to 2019. And in fact, I love the question about interest rates. When you look at rates right now, just north of about 6%, let's say on the 30-year fixed, the overall average was well above 7% over the last 10 years. So I don't believe we'll see the pandemic levels. I think that this rebalance and some of the stabilization that we've seen is what we're going to expect for 23. Rates are going to bounce around a little bit. Number of sales may bounce around a little bit, but I think the majority of the market changes are here to stay for this year.
All right. Well, thanks, Nick, for being with us. We appreciate your insight.
Thanks very much.
Meanwhile, changes in the mortgage industry could mean higher costs for home buyers with a good credit score and lower costs for those with a lower credit score. It is all because of a new federal rule. ABC's Andrew Dimbert has more.
It's a change many homeowners will find surprising. Beginning next month, some people with good credit scores may actually end up paying higher mortgage fees, while those with lower credit scores will pay less.
Because of these changes, the advantage of having a higher credit score or making a larger down payment is not as big as it used to be.
It's a new federal rule going into effect May 1st.
The change that the administration made is meant to make it easier for borrowers who have a lower credit score.
The goal is to boost affordable housing and provide more equitable access to homeownership.
The administration's stated purpose behind making these changes is to help make it easier for borrowers who have historically been disadvantaged and have had a hard time accessing credit.
First-time home buyers with credit scores ranging from 720 and 760, for example, could pay more under the new rule.
They could see an extra $2,600 on a mortgage of $350,000. It is real money, but not enough to break the bank.
Critics say the rule subsidizes homeowners who shouldn't be getting a mortgage in the first place.
It's another subsidy.
Experts say the biggest increases could be felt by those who put 15 to 20% down on a home.
You might choose to put down a somewhat smaller down payment, say 5% instead of 7%, and that might make a difference for you.
Andrew Dimbert, ABC News, New York.
All this comes as a report from the monthly Consumer Confidence Survey suggests confidence in the U.S. economy is going down. That survey is done by the Conference Board, which is a nonpartisan economic think tank. According to their latest survey, consumer confidence dropped from 104 in March to 101.3 this month. Since last February, it's been at low levels that are typically associated with a recession taking place within the next year. The number only briefly crawled above that territory once in December.
So as we talk about all of these changes, what exactly are the consumers' concerns? Well, there are two parts to the Consumer Confidence Survey: the Present Situation Index and the Expectations Index. The Expectations Index showed that fewer consumers expect the business and labor market to improve in the next 6 months. Just over 13% expect business to improve. That's down 3% from last month, but that's despite an increase in confidence about how the economy is doing right now. Consumers' assessment of present labor market conditions did improve slightly from last month, with just under half of respondents saying that jobs were, quote, plentiful, up almost 2%.
Two reports out today show mixed signs about where the U.S. economy is headed. That's based on numbers from two government departments. The gross domestic product appears to be cooling off. The Department of Commerce says it slowed to 1.1% in the first quarter of this year. Slowing GDP growth suggests rising interest rates and high inflation are weighing on businesses and consumers. However, it looks like most employers are holding on to their workers. The Bureau of Labor Statistics says first-time jobless claims fell to 230,000 last week. That is despite predictions of a slight increase, according to analysts. Remember, you can watch the full big story from today and other days on our 13 ABC News app. It is available as a free download in your app store.